Thank you very much for connecting again for the light in the markets maze with me, Dr. Ryan Lehman and Dr. Bhaskar Dasgupta. Thank you very much for joining. We will talk today about and perhaps make a reference to our last episode when we talked about the bear market rally from mid-June to mid-August. The stock markets went up by 10-15%, and since then, of course, as you have predicted and as our survey mentioned, that indeed the bear rally has stopped. We are today back to the 4,000 points area. We even went to 3,900 a couple of days back. So what's your view on this, Dr. Ryan? How will the stock market behave?
Hello, everyone, and great to be back on another episode. So what's happening is basically a number of waves, which is quite typical whenever the cycle turns in the US. So the first wave we've seen is the wave of buy the dip, which we've all seen. So as soon as the S&P 500 dipped, everyone were like, buy the dip. And we've seen lots of particularly retail investors buying the dip. Then we had a second wave, which is this time is different. And again, we've seen a dip and people were saying, this time is different, let's buy. And then they bought again, and then it went up again. Generally, the third wave is the one where we see the panic selling. Panic selling comes because people lose on their shorts and lose on their longs. Until we see this, we cannot call the bottom yet. So for now, we're still in that third wave, which hasn't crystallized yet. The VIX hasn't even touched the 30s. We haven't seen any panic selling being done yet, but we do think, and this is our opinion, obviously, that this panic selling will be coming eventually, and then we will see this drop on this third wave we are in at the moment. After the panic selling happens, obviously it's next to impossible to time the market, but as soon as we see this panic selling and the VIX spiking up, this is when we recommend equities investors to start buying and accumulating to average out their purchases. The bottom is very hard to see. It depends on many factors, among which Europe and Asia, and these are subjects we'll be talking about shortly, I suppose.
Let's have a look at emerging markets. Of course, we have 70 plus countries which sovereign bond is being at risk, and we are seeing higher yields. Could we see another Sri Lanka, or on the contrary, some emerging countries will be doing well? I'm thinking here about India. Dr. Bhaskar, perhaps you have a view on this. We heard there are rumors that India will join JP Morgan bond index. How is this news taken in the country?
So so a couple of things on the broader emerging market side. I think all their balance sheets and macroeconomics are in stress, and it's not going to get better because people are starting to raise, for example, protectionist barriers. We had the situation that India suddenly started to tax rice exports. Now, when you start to tax rice exports, that basically means that obviously the supply of rice, which is one of the major components of inflation as well as emerging markets, is going to start getting higher, and which is already the case. And that is going to start feeding through to the inflation to the countries which are least able to influence it. So the IMF is extremely busy these days, not just, as you said, in Sri Lanka, but with other countries as well, because that is starting to hit pretty basic issues. Now, one of the things that Dr. Ryan mentioned, that is that the price of oil has dropped. Last time when we talked about, we said it's moving up and down. Let's not forget that the actual total cost of oil is still quite high. So for emerging markets, you are basically saying, do you want to get 10 hits or 9 hits? That you're already going to get some substantial amount of hits already. So the fact that it's going to come down from 10 to 9 isn't going to substantially change the macroeconomics or the balance sheet stresses that these countries have.
Perhaps the oil price is reducing in dollar terms, but when it comes to emerging market currencies, it actually stabilized or even went higher.
Exactly. And the markets are also getting thin, and the liquidity is troubling because a lot of money is floating out of these countries back into the US. So those issues are definitely there. And then just to talk about India just a little bit more, and Asia. So you do have the ongoing lockdowns in China. That is causing the productivity and the GDP growth to suffer. Firms are starting to move production out of India, and I was there in India last week. There seems to be quite a lot of animal spirits floating around in India. For example, as you mentioned, the potential inclusion of India into the JP Morgan Bond Index, which is going to move a substantial amount of institutional money into the Indian bond market. So that is perhaps a slight glimmer of light in that area. But emerging markets globally will remain and will become even more challenging as life goes on.
So what do you think, Dr. Bhaskar, just remain in the region with China? China, it's bloated property market, a lot of credit. How do you see this story unfolding?
So obviously, when you talk about China, you have to almost always make reference to the political piece as well. Now, with the big Congress event coming up, the powers that be want to make sure that the macroeconomics are stable. You don't want to see issues on the street. But as far as we are aware from outside, the protests where people are not wanting to pay for their mortgages or are raising for a lot of issues with the local, state and provincial governments, the real estate issues that are afflicting the developers in China are starting to stress out some of the local government economic activity. And because of that, combined with the lockdowns because of COVID and a variety of other reasons, not just without forgetting the geopolitical issues arising from Taiwan, I believe that the Chinese economic activity is going to be subdued for some time. How long? We don't know, but that is definitely a factor.
Perhaps, Dr. Ryan, if you can tell us a little bit about the quantitative tightening that is not happening in the US nor in Europe. Europe, despite its increase of 75 basis points, I believe that the rates are today at 125%. The ECB rates are at 125%. I'm wondering if the central banks will, after these hawkish rate hikes, move into quantitative tightening. What do you think, Dr. Ryan?
This is the main problem. Interest rates alone will not reduce inflation. Not when there's huge geopolitical stress, not when energy prices are sky high, not when there are disruptions right, left, and center. To reduce inflation and control it, the central banks have to reduce their balance sheets. They have to reduce the M2. They have to reduce money supply. This is the only way to do it. The second very essential factor for reducing inflation rates is that risky asset prices have to drop. As long as risky asset prices remain very, very high, this creates wealth effect at consumers, and consumers, they feel they can consume more than actually can. So the risky asset price inflation that we've seen over the years and years that have passed on the back of quantitative easing has to be reversed. It's as simple as that. So when we say that the central banks have to break something to reduce inflation, it is correct. They have to break something. And this something that has to break is the risky asset prices that are astronomically high. When price to sales of the companies in the US, for example, averages 2.5 to 3, this is very, very high from a valuation perspective, given the fundamentals. So yes, central banks have to do QT, have to break something to control inflation.
How will that look, let's say, on another asset class, which is property? Property globally in the US, but also in the UAE. I believe that Dr. Bhaskar, you are having some views on the UAE real estate market.
Yeah. I mean, if you look at it, obviously the US economy is one of the big bellwethers for it, and it has started to show a bit of a turn. And I don't know how much and by how long, but definitely there is some upheaval coming up in the real estate market in the US. In terms of Europe, and specifically in London and in the UK, strangely enough, the market doesn't seem to have come off the boil. But the estimation is that it's still showing foreign buyers coming into the market. Now, coming back into the UAE, the thing that we are seeing, at least from my firms and what and the family offices that I'm speaking to, real estate, especially in the Dubai area, is quite popular. And there's some very interesting projects getting announced. You would have seen the announcements from the Dubai government about some really eye-catching projects that they are proposing. And that is to capture and actually boost the further demand for real estate. So my gut feel is that the Dubai market specifically and UAE more broadly will be one bright spot in that area. So I expect some kind of a portfolio rebalancing happening within the UAE itself. In India, for example, I actually thought that it would come off the boil, but no, it is powering ahead. There is quite a lot of money going into the various elements of real estate. And I've already spoken about the Chinese real estate problem, which is becoming a bit more subdued.
I would like to conclude, look at 2023 and how this year will look like. If there is quantitative tightening, which I believe this is something of a must, increasing rates will not be enough to reduce the inflation. Will this lead to a soft landing, i.e. a recession that will last just a little bit and that will not go very deep? Or the country, there are some chances at risk for a hard recession? Dr. Bhaskar, Dr. Ryan?
My gut feel is that I think we still have about 4 months to go. And despite, if you recall, I think it was in our second podcast that we talked about that the midterm elections are going to play a fairly big role in how the next year is going to turn out. And at that point in time, I had said that I think the Republicans will sweep both. But since then, you had the big infrastructure bill being passed. We see President Biden being a bit more ambitious, the issues facing ex-President Trump. It looks like there's going to be a bit more flexibility in the midterm elections. Inflation, I agree. I stand by what I had said before. That is not going to come down. It's going to keep on having an issue. And finally, winter is going to come. And I can't see supply for energy changing that much, despite the interest rates and the attempts by the central bank to reduce industrial activity. It's not. So my suspicion is I'm trending towards a downturn next year.
For me, it's about energy and geopolitics and its effect on Europe. And this is how it trickle down around the world. I will start with Germany, because Germany is the majority of Europe from a GDP perspective. If you look at Germany now that Nord Stream 1 is shut down and there's no gas inflow anymore to Germany, German households will have to reduce their consumption of liquid natural gas by 25%. The German industry will have to reduce its consumption of natural gas by 26%. Electricity producers in Germany will have to reduce their electricity production based on gas by 46%. That means Europe in the winter will have a very, very serious problem. This is the biggest energy event, biggest energy shock we have seen since the 1970s oil embargo, okay? This will have very deep implications on Germany, on Europe, and the rest of the world. Unless there is a geopolitical resolution with regards to Ukraine and Russia, and things normalize to a certain extent, I see a very dark winter in Europe, a very hard landing, and a deep recession. And in the US, definite downturn, maybe not a hard landing, It could be what everyone is calling a soft landing, a mild recession, rather than any disasters. And this will obviously reflect on risky assets and others.
So to summarize, probably stock markets will still have some troubles. Now the question will remain how lower they can go. Will it a little bit? Will it be further? Thank you very much both for your time. I think that our viewers recognize the value of these Light in the Markets Maze episodes and podcasts, and they're enjoying it. And we keep on telling them, at least for this episode as well, that protective strategies are the way to go. Thank you very much, Dr. Ryan. Thank you very much, Dr. Bhaskar.
Find a maze. Amazingly smart, amazingly you.